How would you like a situation where you are hired to do a job for $1,000 and you finish the job and I come to you and I say, hey, give me 20%, give me $200 of the money. You'd look at me and you'd be like, are you insane? Well, in today's video, I'm going to show you that this company is exactly the kind of company that is getting those kinds of 20% of somebody else's work. If you're new to this channel, my name is Mariusz Konieczny. I run Microcap Explosions, a website dedicated to microcap stocks, which are ignored and underfollowed by the investment industry. I also wrote 10 books on investing, one of which is available for a free download at microcapexplosions.com. I also created valueinvestinguniversity.com, a free resource to make you a more intelligent investor. In the example that I gave you at the beginning, where I told you a scenario where you would do $1,000 work and I would just come out and say, hey, give me 20% of it, you'd probably throw me out the door or kick me out the door because, you know, I don't deserve 20% of your work because I didn't do any work. But this company called, I think it's pronounced Fiverr, is exactly the kind of business. It's a platform, it's a website where service providers come to get work and then the buyers come in to bid on their work. And Fiverr is in the middle, just chipping 20% from the work. So it's this kind of business model that I'm looking at and I'm like, wow, this is incredible. I wish I owned the whole thing because everybody's doing all the work and I'm just getting money from it. There are two main competitors in this space. There's Upwork and Fiverr. So what kind of work do they do? Picture this. You want to write a book and you know what to say, you're an expert in your field, but you have no idea how to design a cover. I mean, if you did design a cover, it would look pretty amateurish. And you don't know how to do interior design. But you want the book to look good. You want a nice cover, you want a nice interior design because you want it to look professional. And you also want to hire an editor, but you don't know anybody. And you've had a bad experience before with working with someone. And I did that. When I published my first book, I needed someone to do the cover, edited, and interior design. And the editor that I used recommended me a particular person that would do the cover design. It cost me $6,000. $6,000 for the editing, book cover, and interior design, right? Because the people that were providing the service, they were just quoting me the price and they didn't have any competition. Like there was nobody else bidding on the job, right? So that was my first book. Why are we so clueless about the stock market? The second book, it was a complete disaster. I used somebody else who was cheaper, recommended by a friend, but it was a complete disaster because this lady, I couldn't believe it. Like she would insert mistakes into my book. Like she would put paragraphs in places where they didn't belong. She would put words from a different book. It was complete nightmare to work with her. So then I started using a website like Upwork or Fiverr to find people to do work for me, whether it is design a logo like they did for Microcap Explosions and even to do a website. At first I created my own version of Microcap Explosions, but then I hired someone to do a website for me, Microcap Explosions. I also hired somebody to do valueinvestinguniversity.com. By the way, you should go and sign up to do that, right? Because they can do a better job. They do this every day, they make it pretty, and I look good when they make it. And to do this, I don't go out and try to find a person. I go on Upwork or Fiverr to find people that can do it for me because there's a lot of people that go to Upwork, designers, editors, they go and then they bid on services. So I post a job, I want a logo done, and then there's like 20 people that are bidding on that job. And then I go through every profile and I choose a winner. And then that person, let's say, does the work for $100, does a logo for me for $100. Fiverr gets 20% of it. And Fiverr didn't do anything, right? All the Fiverr did is connected us. And that's why this business is great. Because people like me on the buying side want to use that because we want to find people that, first of all, compete on our work, which means that the price is going to be lower. But also we want to find good people, okay? Because we've had bad experience or we don't know anybody. So that's why buyers go there. Why do service providers go there? I mean, If I was a service provider, I wouldn't want to go there because like I have all this competition. I have to do all this work for very low money or lower money than if I go directly to the customer, if I have my own clients. And if you design logos or you design book covers or you're an editor or whatever, yeah, you want to have your own clients. But you see, the problem is that this takes time to build a clientele. It takes money to build a clientele. You have to build your social media. You have to maybe have a YouTube channel to grow your subscribers so that you can have people to do work for. That takes time. It's a lot easier to be like, hey, I can do a logo because I just finished a design school. I will go on Upwork and I will bid on jobs. So that's why so many people go there. So that creates an incredible business model because it's a business model where you have a network effect. Okay, that's a moat. The more providers that are on the platform, the more buyers want to be on the platform because they know they can find someone that will do the work. The more buyers that are on the platform, the more providers want to be on the platform. And it just continues to grow and the moat continues to strengthen. And then as the moat strengthens, then the platform can charge even more money. Even though it already has incredible profit margins, in 2019, it had profit margin of about 79% on only 100 million of revenues. In 2021, revenues were almost 300 million and the gross profit margin increased to 83%. So the margins are increasing, the moat is increasing, the business is wonderful, high margins, doesn't have like recurring revenues, but it has repeat business. Because for example, when I created the microcapexplosions.com, I hired a guy to do it, and I hired him on a monthly basis to maintain all my websites. So that's a recurring revenue. But every time I want something from him, like, hey, do valueinvestinguniversity.com, that's obviously outside of that maintaining the website, he wants to go through Upwork, right? Which is a competitor to Fiverr. Why? Because he doesn't want to deal with taxes and tax forms. It's easier for him to have Upwork take 20% of what he makes than for him to mess around, get his own payment, this and that. So it's amazing. It's like repeat business. So if you were an owner of this, how would you grow this business? Well, you would want more users to be using it. That's number one. And you would want each user to spend a little bit of more of money. And that's exactly what's happening here. In 2018, the average price per transaction was $145. By 2021, that average price was $242. So that's growing, that's wonderful. And then the number of users are growing. In 2020, there was 3.4 million active users. By 2021, there was 4.2 million users. Now, 4 million users, it's a lot of users, but the world is big. There's plenty of room for growth. So you have a growing business, high recurring, high margin business, protected by a moat, and it's also capital light because what did the company have to do to go from 3 million users to 4 million users? Not much, right? The platform is there. You can just add more people. The business model is not capital intensive. And you will be able to see that when I go over the cash flow statement. You'll see how tiny the capital expenditures are. So let's go ahead and take a look at the income statement, cash flow statement, and balance sheet. On the income statement, we can see that in 2019, the company made about over $100 million of revenues. By 2021, those revenues were 3 times as much, 300 million. Look how tiny the cost of revenue is. The cost of revenue in relation to revenues, tiny. The gross profit margin here was about 79%, and then here it was about 84%. So they increased gross profit margin. The cost of revenue is so tiny because they don't have to have any inventory. They're not providing the service. They're just shipping off 20% or 20 to 30% of whatever the final price is. And this is mostly like just support and then payment transactions. So that's why the cost of revenue is so tiny. So because you have such a big gross profit margin, you can now plug a lot of money into sales and marketing, right? Sales and marketing is the biggest cost contributor here. And that's because this is the driver of revenue. This is the investment in the brand. This is the investment in more users. So this is a good expense. This is an investment. And then the second one is research and development, which is, how can we make the platform better, more user-friendly and things like that. That's the second biggest. And then the third biggest is general and administrative. But you can see that the company is negative, it's losing money, right, on net income. And that's purely because they choose to spend so much money because it's beneficial for them to put it into marketing and grow. So that's their choice. They could, of course, be profitable on a net income basis if they wanted to, but then the growth would slow down. And when you look at, growth companies like this is an example of, how I'm looking at a growth company, but I'm paying attention to the numbers. I'm paying attention to the valuation here. Let's look at the cash flow statement. From the cash flow statement, you can see that the company is actually profitable on a cash flow basis. It was cash flow positive in 2020. It was cash flow positive in 2021. Then when you look at the investing activities section of the cash flow statement and you look at purchase of property and equipment, this is the CapEx. So this is what I was telling you, is that because the CapEx are so low in relation to revenues or gross profit, that shows you that this is a very capital light business model. So when the profitability comes, or when they choose to become profitable and the cash flow big cash flow is going to show up here, what can they do with the cash flow? Because the CapEx is so limited, then they can do a buyback, they can do dividends, they can acquire a company. If they acquire a company, that will show up in the acquisition of businesses. And look at this. Here, they did make an acquisition. If they do pay a dividend, it will show up in the financing activities. And if they do a buyback, it will show up in financing activities. Let's look at the balance sheet. On the balance sheet, you can see that they have close to $200 million of cash. This is cash and cash equivalents. And then the second line is marketable securities. So they're just parking the money here, earning very little bit of money, but that's mostly cash. So close to $200 million of cash. Unfortunately, they have debt, okay? Close to $400 million of debt. So I don't like that, but it is what it is. I'm not running this company. Let's go back to the income statement again. So 300 million of revenues, yeah? Let's look at the stock price. As you can see, the stock price peaked at 320 in February of 2021, and it's been going down since then. And now at the peak, when the company had a stock price of 320, the market cap was 13 billion, 1-3. At that point, if we compare it to the revenues, and we can't compare it to these revenues because it was February 2021, we have to compare it to these revenues, it was trading about 43 times sales. I mean, I love the business, but I don't love the fact that somebody was paying 43 times revenues for a business that's, very far along in the development stage. I mean, it's not a complete startup with a tiny base. It already has 200 millions of revenues. So 43, it's pretty steep. But now the stock price is at 75. The market cap is about close to $3 billion. Now $3 billion in comparison to 300 million of revenues, well, now that's 10 times revenues. Is 10 times revenues reasonable for a company like this? Well, it's a wonderful business. I love the business. I definitely don't like 43 times revenues. That's a definite no for a company like this. 10 times revenues, I wish it was 5 times revenues. If it was 5 times revenues, it would be like, bam, no problem, fantastic. 10 times revenues, it's I would say it's still reasonable, but it's getting borderline to maybe it's getting a little bit too expensive. But I don't know if we'll ever get more expensive, because it seems like maybe we're getting closer to the finish of the sell-off, and maybe this company will never trade at anything like less than that. So you tell me. I mean, for me, I wish it was 5 times revenues, so I probably would not be buying it for myself. But do you think 10 times revenues is a reasonable valuation? I mean, the company has definite path to profitability, no question about it. It's going to be profitable in the future. It's a great business model. It's not a Ponzi scheme. It's a solid company with a solid business model. So because the margins are so high, there will be plenty left over for cash flow or for net income in the future. So of course, in the future, it will trade on free cash flow, net income, whatever, but the revenues are going to be much higher from the current levels. But right now, it is what it is. It's trading at 10 times revenues, and you tell me, do you think it's reasonable or not? Any opinion is welcome. So thanks for watching.